There is a number hiding in your investment account right now. It is not your balance. It is not your return percentage. It is a smaller number. A number so small, it looks like a rounding error. In over 30 years, that number will quietly remove $230,000 from your retirement. You will never receive a bill. You will never see a deduction on your statement. The money will simply not be there when you arrive. Today, we are going to find that number, name what it is doing to you, and fix it in about 15 minutes. If you want more breakdowns like this on Sarah's Money Map, subscribe before we go any further. It is the best 15 seconds you will spend today. Now, let's talk about how a fraction of a percent becomes $250,000. Here is the scenario. Two people, call them Claire and Priya. Same age, same income, same goal. They both put $100,000 into an S&P 500 fund on the same day. Same market, same returns. 8% a year every year for 30 years. On paper, they are doing identical things, but there is one line in their fund documents that is different. One number that most investors have never looked up. Claire's fund charges 1% per year. Priya's fund charges 0.03% per year. 30 years later, Claire has approximately $761,000. Priya has approximately $1,006,000. Same market, same starting amount, same time horizon. The only difference is that single mine. The gap between them is $245,000. That is not a calculation error. That is the fee shadow. The fee shadow is what happens when a small annual percentage compounds against you for decades. It is not just the fee itself. It is everything that fee would have earned if it had stayed in your account. Claire does not just lose 1% of her balance each year. She loses 1% plus all the future growth that 1% would have generated for the remaining 29 years. Then 28 years. Then 27. The shadow grows longer every single year. Here is how to picture it. Imagine a bar representing Claire's balance growing taller each year. Now imagine a second shadow bar growing alongside it. That shadow is not Priya's account. That shadow is the money Claire's account should have had, quietly siphoned away year after year. By year 10, the shadow is noticeable. By year 20, it is significant. By year 30, it is $245,000 tall. Same bar, same growth rate. But one account has been feeding a second bar that belongs to the fund manager, not to Claire. The reason this feels invisible is because it is invisible by design. You will never receive a statement line that says, fees charged this month, $412. The fund deducts its fee daily, in tiny fractions directly from the fund's net asset value before your balance is calculated. When you open your app and check your account, the fee has already been taken. You are always looking at the number after the subtraction. The check has already been written. You just never see it. Now you might be thinking, 1% does not sound like much. I get it. $1 per year on every $100 invested. That is the price of a coffee. And if it stayed $1 forever, it would not matter. But it does not stay $1. Because your balance grows, the fee grows with it. In year 1 on $100,000, that 1% costs you $1,000. By year 15, your balance has grown and the annual fee has grown with it. By year 25, you are paying fees on a much larger number. You are paying 1% on the gains too. On the gains of the gains. The fee compounds just like your investment does, except it is compounding against you. This is the mechanism that turns a small number into a large one. And there is a second layer that makes it worse. S&P Dow Jones Indices publishes a scorecard every year measuring how actively managed funds perform against their index benchmarks. The data going back 20 years shows that 94.1% of all domestic actively managed funds failed to beat the S&P 1500 composite over that period. Not underperformed slightly, failed to beat a simple index that anyone can buy for 0.03% per year. Claire is paying 1% annually for active management. Over 15 years, roughly 9 out of 10 funds charging that fee will return less than the index Priya is holding. Let that sit for a moment. Claire is paying more, getting less, and losing $245,000 to the gap. The natural objection here is this: what if my active fund is one of the 10% that beats the index? It is a fair question, and the answer requires honesty. Some funds do outperform in a given year. Some even outperform for 3 or 4 years in a row. But S&P's persistent scorecard shows that consistent outperformance is nearly impossible to find and nearly impossible to maintain. Among top quartile funds measured over a recent 5-year period, only 2 out of 169 funds remained in the top quartile for the following 4 years. 2. Past performance is not a guarantee. It is barely a signal at all. So you are not just betting that your fund manager is talented. You are betting that they are one of the rare exceptions who sustains outperformance for the entire 30 years of your investment horizon. And you are paying them 1% per year for that bet, win or lose, up market or down market, whether they beat the benchmark or trail it by 4 points. The expense ratio is the only fee in your investment life that you pay regardless of results. Here is what this means for you on a practical level. The fee is not a problem you can solve by picking a better active manager, because the data says you cannot reliably identify who the better manager will be in advance. The fee is a problem you solve by switching to a fund that does not charge it, or charges almost nothing. Morningstar's 2024 fund fee study found that the asset-weighted average expense ratio for active U.S. equity funds was 0.60%. The asset-weighted average for passive index funds was 0.11%. Vanguard's VOO and Fidelity's FXAIX, both straightforward S&P 500 index funds, charge 0.03%. That is 3 cents per year on every $100. That is the difference between Claire and Priya. Not different markets, not different timing. 3 cents versus $1 on every 100. Let's talk about what to actually do. This is the 3-step protocol, and you can complete it this week. Step 1 is to find your expense ratio. Log in to your 401k or brokerage account. Open the fund details page for each fund you hold. Look for a line that says expense ratio or net expense ratio. It is in the fund fact sheet or the prospectus summary. Write down every number you see. If you hold 4 funds, write down 4 numbers. This step takes about 10 minutes. Step 2 is to apply the threshold. If any fund shows an expense ratio above 0.20%, that fund is worth examining. If it shows 0.50% or above, it is almost certainly costing you more than it is earning you relative to a low-cost alternative. The benchmark for comparison is 0.03 to 0.05%. That is what broad market index funds charge today. Anything significantly above that needs to justify its cost with sustained, documented outperformance. Check the fund's 5-year and 15-year performance against its benchmark index. If it is trailing the benchmark after fees, you have your answer. Step 3 is to find the equivalent. Search for an index fund that tracks the same market your current fund targets. If you are in an actively managed U.S. large cap fund, the equivalent is an S&P 500 index fund. If you are in an actively managed international fund, there are low-cost international index alternatives. Most 401k plans offer at least one index fund option. If yours does not, that is worth raising with your HR department. In a brokerage account, the switch is straightforward. The tax implications of selling depend on whether you are in a taxable or tax-advantaged account. So if you are in a taxable account, a quick check with a fee-only advisor on the tax cost of switching is worth 15 minutes of your time. That is it. 3 steps. You are not timing the market. You are not picking stocks. You are reducing the silent drag on everything you have already built. The silent drag is the second half of what the fee shadow creates. The fee shadow is the cumulative wealth you lose to compounding fees. The silent drag is the ongoing force slowing your account down every single day in every market condition without pause. Reducing it is one of the only investment decisions that is entirely within your control. You cannot control whether the market goes up or down next year. You cannot control inflation or interest rates or what happens to any individual company, but you can control this number. And this number over 30 years is worth $230,000. That is not a fee. That is a decade of retirement income. Claire and Priya both did everything right. They both invested. They both stayed in the market. They both chose S&P 500 exposure. The only difference was a number smaller than a rounding error on the surface and $250,000 in reality. Priya did not pick better stocks. She did not time the market. She checked one line in a fund document that most people skip. That is the move. Check the line. I want to hear from you in the comments. Log into your account this week, find your expense ratio, and drop the number below. You do not need to share the fund name, just the number. I want to see what people are actually paying, because I think a lot of you are going to be surprised. If this breakdown helped you see something in your account you had not noticed before, hit the like button. It helps Sarah's Money Map reach more people who are losing money to a fee they have never seen. I will see you in the next one. This video is meant to inform and entertain, not to give personal financial advice. Investing carries risk, so please do your own research. AI tools may support production, while final review and editing are done by me, Sarah.